Shwai everyone. A lot of talk lately about silver moving into the kind of setup that can change the whole conversation around money, markets, and what people actually trust. So in this video, we're going to separate the real signal from the loud noise, and you're going to walk away a lot sharper and a lot more confident about what's actually happening here. Today is Thursday, April 16th in New York. So comment the day and the date you're watching from. And real quick, if you value this kind of breakdown, support the channel by subscribing and commenting John A.G. Best. It really does help. Now, a lot of people look at silver and they see a quote on a screen. That's the first mistake. Because the bigger story right now is not just silver, it's confidence, it's pressure, it's whether the system is still pricing reality honestly, or whether it's mostly pricing habit, policy, and denial. Silver has people paying attention again. Gold has already gone ahead and done what a monetary warning signal is supposed to do. Oil has put fresh stress back into the inflation story. And yet large chunks of the broader market still behave like this is just another temporary panic that'll fade the second the next headline rolls in. That disconnect matters, more than most people in this market realize. Because when hard assets are saying one thing, energy is saying one thing, and policymakers are boxed in from multiple directions. While financial assets keep acting sleepy, one side of the board is wrong. And I don't think it's the hard assets. Now let me slow that down. The loudest silver argument you hear online usually goes straight to collapse. Total breakdown, instant reset, overnight explosion. And look, I get why people talk like that. Silver is emotional. It's small enough to move hard, old enough to carry history, and misunderstood enough to create obsession. But you do not need an overnight disaster for silver to matter. You don't need the entire financial system to freeze. You don't need every paper promise to fail tomorrow morning. You just need confidence in the old setup to weaken gradually, then suddenly become visible to everyone at roughly the same time. That's when repricing gets violent, and that's why silver matters. Based on the latest industry outlook, the global silver market is expected to log yet another structural deficit this year, extending a multi-year run of undersupply. The same research says hundreds of millions of ounces have already been drawn out of inventories over the last several years. That matters because a market can look liquid right up until the moment people discover the float is thinner than they assumed. And here's where people get tripped up. They think price is truth. No, price is the quote. Truth is what the market has to pay once trust gets expensive. Silver already gave us a clue. Even after cooling from those crazy highs we saw earlier in the cycle, it did not simply roll over and go back to sleep. The latest market work says coin and bar demand is expected to rebound strongly this year, while available London liquidity has improved from the squeeze conditions of late last year without exactly becoming abundant. In other words, pressure came off the most extreme point, but the market still doesn't feel loose. That's not the same thing as saying silver has to go straight up from here. It doesn't. Nothing real ever does. But when a market keeps running deficits, when investment demand reappears on weakness, and when macro stress keeps feeding the story, you're not looking at a toy anymore. You're looking at something with teeth. Now zoom out. A lot of people talk about debt like debt is the whole problem. Debt matters. Of course it matters. But debt by itself does not break a system. Big systems can drag around absurd debt loads for years. They refinance. They smooth it over. They play accounting games. They hope nominal growth outruns the pain. What breaks the system is when people stop believing the promises surrounding the debt. Trust is the hidden collateral. And when trust starts slipping, the move can happen much faster than the public mood. Now, is trust already completely broken? No. And this is where I want to challenge the most dramatic version of the silver story. If the world had fully abandoned the dollar already, foreign money would not still be piling into U.S. treasuries. But official treasury data show foreign holdings hit a fresh record in February, which tells you the dollar system is still deeply embedded, even while confidence in it is being questioned at the margins. So anyone telling you the old order is already dead is getting ahead of the tape. But that does not mean the system is healthy in a deeper sense. It means this transition is messy. Because on one hand, reserve managers still need size, liquidity, and familiarity, and the dollar still gives them that. On the other hand, the latest IMF reserve data show the dollar's share of disclosed global reserves slipped again in the final quarter of last year, while the share going to the catch-all category of other currencies has more than doubled since 2021. That is not an overnight overthrow, but it is erosion, and erosion is exactly the kind of backdrop where silver gets more interesting, not less. Gold has already been sending that message loud and clear. World Gold Council data show total gold demand in 2025 topped the 5,000-ton mark for the first time, with record value and massive exchange-traded fund inflows. The same body's central bank survey found an overwhelming majority of respondents expect official gold reserves to rise over the next year, and a record share said their own institutions plan to add. Think about what that means. The institutions closest to the plumbing of the monetary system are still reaching for monetary insurance. And one more fresh point here. Gold exchange-traded funds pulled in enormous inflows last year, one of the strongest annual increases on record, which tells you institutional money has already started voting with capital, not just with commentary. When big money begins rotating toward monetary metals while broad reserve managers also keep leaning toward gold, silver usually doesn't stay ignored forever. It tends to play catch-up, then it tends to exaggerate. That's why patience matters right now, just as much as conviction does for prepared investors. And silver, because it sits in that strange middle ground between monetary metal and industrial input, has its own special kind of leverage. That double identity is powerful. It means silver can be pulled by fear and by usefulness at the same time. Now let's talk oil, because oil is where this gets more dangerous. Oil is not just another commodity. Oil is pressure. It runs through transport, shipping, food, manufacturing, and expectations. It gets into everything. And the latest government energy outlook says Brent averaged just over $100 in March after a huge month-to-month jump, with a peak forecast in the current quarter and prices expected to stay above pre-conflict levels because of supply disruption risk. That's not a comfortable backdrop for any central bank that was hoping inflation would quietly disappear. And the Federal Reserve knows that. Recent remarks from Fed officials show they are not treating this oil shock like background noise. One policymaker said higher oil prices could keep core inflation near 3% for much of this year, and argued rates may need to stay restrictive for quite some time. That matters because it pushes back against the lazy assumption that the Fed can just come charging in with easy money whenever growth wobbles. Now, eventually, could policymakers still choose inflation over pain? Sure. History says governments usually try the politically easier route until the market forces a different choice. But right here, right now, the setup is more complicated than the cartoon version. And that actually strengthens the silver thesis. Because if the Fed cuts too early, it looks soft on inflation. If it stays tight too long, it increases financial strain. If fiscal deficits keep ballooning while financing costs stay elevated, confidence takes another hit. Either path creates dissatisfaction. Either path pressures the currency. Either path keeps real assets in the room. And that's the part people miss. Silver does not need one perfect scenario. It benefits from a menu of bad trade-offs. Now, another word people throw around constantly is manipulation. Rates are manipulated. Metals are manipulated. Oil is manipulated. Stocks are manipulated. Bonds are manipulated. My view is a little more sober. Some prices are clearly influenced by policy and market structure far more than the average person realizes. That's true. But you do not need a secret meeting in a dark room to explain every weird move. Sometimes the distortion is built right into the machinery. When enormous amounts of money flow automatically into index products and systematic strategies, when huge pools of capital react to volatility bands and benchmark weights instead of reading the world like a thinking human being, strange pricing happens. You get calm where there should be urgency. You get indifference where there should be repricing. You get miners lagging bullion. You get energy equities underreacting to geopolitical reality. And that creates opportunity for anyone still willing to think. That's why I think the better framework is not panic. It's mispricing. It's not that everything has to break tomorrow. It's that the market may still be slow to process what rising hard asset prices are trying to say. And if that's true, parts of the real asset space may still be early. Now, on the equity side, one example people keep bringing up is Nexa. I'm not telling you to buy anything off one video, so don't do that. But I understand why the name gets attention. If you've got a producer with meaningful silver exposure, with silver not even being the whole story because other base metals sit beside it, then higher silver prices can change how the cash flow math looks in a hurry. The key point is not the ticker. The key point is that the market may not have fully repriced operating leverage across the miner space yet. That deserves homework, because if silver stays elevated or breaks materially higher, equity valuations won't be able to hide from arithmetic forever. And that is how repricing begins. Not with a slogan, with math. Now let's step back into the historical frame. The most dangerous market periods are not the ones where everybody is already terrified. The most dangerous periods are the ones where the old model is weakening, but most people still trust it out of habit. That's why historical analogies can be useful, even though no two eras ever line up perfectly. When energy stress and monetary credibility start feeding on each other, markets usually do not move in a clean staircase. They lurch, they reprice in bursts, they embarrass linear thinkers, and that is the part silver investors need to understand. If this market really moves into the next phase, it may not go from one tidy level to the next tidy level in a calm sequence. It may jump, it may overshoot, it may scare people out, then run without them. And if you're staring only at the daily quote, you're going to miss the whole point. So I keep coming back to the same question. What do you actually own? Do you own something real? Do you own something useful? Do you own something scarce? Do you own something that does not depend on a committee standing behind a microphone and telling you everything is under control? That's the question. Because when confidence gets questioned, paper claims and real things stop behaving the same way. And silver sits right at that crossroads. It is small enough to get squeezed, important enough to matter, monetary enough to attract fear money, industrial enough to attract practical demand. That combination is rare. And I want to say one more thing, because this matters. Not every silver bull needs to root for catastrophe. In fact, you probably shouldn't. You do not want a world where price discovery totally shatters and nobody knows where anything should trade. That sounds exciting in a thumbnail, but in real life it comes with frozen markets, new rules, forced reporting, and all kinds of ugly second-order consequences. The cleaner version is repricing, not paralysis. The cleaner version is recognition, not systemic chaos. The cleaner version is the market waking up and saying, wait a second, these hard assets were priced too cheaply relative to the fragility in the system. That's the healthier move. So no, I'm not cheering for total disorder. I'm cheering for reality to get priced more honestly. And I think silver is one of the clearest places where that can happen. If you're successful, share your success story in the comments so others can stay motivated. And answer this for me too. Do you think silver's next major move comes from persistent physical deficits, from slower confidence in the dollar, or from energy-driven inflation bleeding through the whole economy all at once? Because my answer is yes. That's the power of this setup. Several roads can lead to the same destination. A tighter physical market helps. A stickier inflation backdrop helps. A gradual reserve shift helps. Renewed investment demand helps. A broader re-rating of miners helps. You do not need every domino to fall in one afternoon. You just need enough of them leaning the same way. And right now, more of them are leaning than most people realize. So here's the practical takeaway. Stop obsessing over every tiny daily wiggle. Stop pretending the screen tells the full truth. Study the structure. Watch inventories. Watch energy. Watch policy language. Watch whether gold keeps getting treated like monetary insurance. Watch whether silver keeps refusing to fully break down when the headlines cool off. And above all, know what you own. Because in a market like this, clarity beats excitement, discipline beats drama, and conviction, when it's built on actual homework, beats panic every single time. That's the game. Not memorizing slogans, not fantasizing about instant collapse, understanding where trust is weakening, where hard assets are quietly gaining ground, and where the broader market may still be asleep. That's where the opportunity lives. And that's why this silver warning matters so much. Not because everything changes in one night, but because once enough people realize what's changing, the price can move a lot faster than their beliefs do. As always, this is here to educate, challenge your thinking, and help you ask better questions. It is not personal financial advice, not a buy signal, and not a substitute for your own due diligence. Protect your downside, do your own work, and make decisions like your future has to live with them.